Talking about earnings, let's also address RBL Bank's numbers, and we've got on board with us Vishwavir Ahuja, the MD and CEO, joining in. Mr. Ahuja, hi, congratulations for an excellent quarter. What's led to this kind of strong profit growth as well as margin expansion? And if you could highlight the key performance drivers for us.
Growth in the bank has been across the board. All our business segments, whether in terms of the wholesale side or in terms of the non-wholesale retail businesses, all have shown very handsome growth across the board. And therefore, the growth momentum is essentially coming from all the areas. Also, at the same time, there are 2 or 3 reasons why the NIM expansion is taking place. In other words, the improvement in the margins that we have witnessed. Margins have improved 51 basis points in this year, and NIMs have touched an all-time high of 3.98%, just short of that milestone of 4%. The reason for this is the consistent reduction in our cost of funding, which has been basically facilitated by increase in our low-cost deposit base. As you can see, the CASA percentages have also been growing. At the same time, I think there has been a slight increase in the proportion of higher yielding assets, largely coming from the retail side, in the entire asset mix. So as the proportion of higher yielding assets increases, that also helps in terms of the NIM expansion. So those are the real reasons.
Yeah, your NIMs have expanded 9 basis points sequentially. What are the margins? The margins at 3.98. Just wondering whether they're sustainable. How is it that you see your yield and cost of funds shaping up?
So NIMs, according to us, are sustainable in the coming year. And actually, we are endeavoring to improve them slightly and make them cross the 4% mark. So that's the first part. In terms of cost of funds, again, I think more or less, we are in the range where cost of funds are sustainable. And I'll tell you 2 reasons why that is the case. Even though there is an uptick in the interest rate environment driven by both global and domestic factors, which may lead to a slight increase actually in the cost of funds. But at the same time, that might get counterbalanced in our case by an expanding base of low cost deposits, largely in terms of the growth in the CASA percentages. So that might sort of offset each other, and on balance, that should help us not just maintain our cost of funds, but also maintain the current levels of NIMs.
Right. Mr. Ahuja, asset quality has shown mild signs of improvement with the GNPAs easing. What has led to this slight improvement? How have slippages and recovery shaped up? Any asset sale undertaken?
So asset quality is strong and solid. We are happy with the levels at which we are operating, and we again expect to maintain these levels of gross and net NPAs going forward. Basically, our corporate, commercial, retail, and the entire other sort of pockets of our business are all operating under very tight risk management rigor, and therefore we do hope that we can maintain those strong standards of risk management going forward, and therefore we are quite confident of maintaining these levels of asset quality. That's the first part. As far as the second part of your question is concerned, that proportion is very small. Basically, I think it is only 0.07% of our total book. Perhaps there is just one item in that category, which is a small item.
While you've spoken about GNPs, your overall asset quality picture, how do you see stress in MFI, corporate banking, agri, commercial, SME space?
As far as our large corporate book is concerned, we operate at very low levels of NPAs. And as far as our commercial banking, which is the mid-market and SME book, there also historically we've had higher levels of NPA, but they have been consistently coming down, and today it is a very well managed book, which is also growing very well. So in aggregate on the wholesale side, actually the NPL levels are, very, very satisfactory. On the retail side also, where if I may break it down into personal loans, into LAP, into card related exposure and so on and so forth, again it is operating at well below the so-called industry benchmarks when it comes to credit costs and NPAs. The only area where in the past, because of the demonetization, and we've talked about this repeatedly in the last several months, where we had concerns was in terms of the provisioning that had to be done on the financial inclusion microbanking portfolio. And some of that provisioning was done in the year March 18, some of that remains to be done in the year March 19. And having said that, the new book that we have created post demonetization in the last 12-15 months today constitutes 90% of that entire loan portfolio. And that 90% of the total portfolio is now operating at a 90-day DPD of less than 30 basis points, which means it's operating at 99.7% collection rates. So therefore, the net proportion of the old stuff, which needs to be finally provided for, is very, very small and is already taken into consideration in the kind of overall asset quality and portfolio guidance that we are giving out.
Now, advances or the advance book growth for the quarter gone by is at about 37%. Where do you see the book could end for FY19 and FY20?
So we have repeatedly again given our 2020 guidance, which says that we expect to continue to grow in the 30 to 35% range on advances. And we are sort of standing by that statement even now. Even though we are now have a much bigger, advances base, and therefore, despite the base effect having changed, we still believe that we will be able to grow in that range going forward.
How has your capital consumption been and the tier 1 ratio, and how long do you think it's going to last?
We are very adequately capitalized. Our capital adequacy ratio is 15.3% right now. The tier 1 capital is about 2 percentage points less than that. So we are extremely well capitalized. I think we are very comfortable in that position and should remain so for the next 7 to 8 quarters before there is any need to look at further capital raise.
Okay. So lastly, any change in guidance for Vision 2020? Because you had been betting on advances book growing by about 30 to 35% CAGR, and also you have stated a return ratio of about 1.5% by 2020. What, according to you, would be the key drivers for the improvement in ROA?
Again, if you look at our guidance carefully, we have fulfilled our guidance, at this midway point from where the guidance started pre-IPO, to 2020. We have been growing all our return ratios in accordance with our guidance. Just in this last year concluded, we grew ROA 13 basis points, and we have been growing that ever since 2016 as per our guidance. We are confident that based on the various aspects of our business where there is growth, there is more profitable growth, and growth is coming in a much more efficient manner. Our cost income ratios are also going down, and our NIMs are going up, and so on and so forth. So all taken together, and our asset quality is very tightly managed. All taken together, both ROA and ROE expansion is also happening at the same time, and that will continue. We are hopeful that fourth quarter 19 we should be able to exit at higher ROA than now, and at approximately 13.5% ROE, which is a significant improvement over today. And therefore, by March 2020, be in line with our guidance, 2020 guidance.
Mr. Ahuja, we wish you the very best for the future. Thanks very much for joining us with those details about your earnings.